Can you see my screen now, please? I think you can. So I'm sorry. I forgot. I'm so excited. I forget to take breakfast. I forget to take lunch, you know. So if you forget to take breakfast, you forget to take lunch, you forget to take sleep, you forget to call, you forget, you know, your wife is in the other room or your daughter, you need to take your daughter to school, it means you are on to something. So that's the sign of a genius. So luckily, breathing is automatic. So sorry. So let me go back a little bit. Um, just a second. So these are the slides. So this is the slide. Analyzing the last week's and coming week's stocks, position sizing. Okay. Then I was talking about how professionals make money in the stock market. I talked about it. Then I said fortune is made by mastering few techniques. I told you about Bruce Lee. Then he said master only one kick if you want to, but master, you know, practice it for 10,000 times instead of 10,000 different kicks. Um, for instance, I have seen on various Facebook posts. I am a member. I see what the traders are doing. They are into this is stock, that is stock, $2 stock, penny stocks, the stock which has moved like 50%, and they are into Bitcoin, and then they go jump from they go into gold, silver, and then they talk about something else. So there is no plan. They don't know the behavior of the stocks. They don't know the market direction. They're just jumping here or there. So that's a foolish way of trading. Whereas the way I trade, I have a list of 500 stocks which get refreshed every now and then. New charts come in, new stocks come in. I add new stocks. Some stocks are bought out. They are no longer valid, so I remove them. And there are some stocks which go below my criteria of like $15–20. They became inactive, so I remove them. So I refresh by 500. Then out of 500, I have a core stocks list, which is about like 200–300. Between 200–300, they are core stocks. So, and then there are high movers like Apple, Baba, Baidu, you know, these stocks. So they are on my separate list. Facebook. So there's a subset of the stocks. Then I have a list of based on the different sectors, the different industry groups, or the stocks which are moving, or the stocks which are supposed to move, like the steel stocks or infrastructure stocks, sometimes the tech stock. So those which are moving, those who have a volume there where people are interested, there's a news coming, instead of just jumping around here and there and they lose money. So that's not the way to trade. So I just follow these and I make money. So if you are a member, you will see you will see like top 50 stocks we are trading. No need to trade other than that. There's no need. So we need to master the techniques which produces high and fast return. So if you combine the swing move, which is like 3–5%, combine it with the option, the return is high. Then I talked about the three strategies: the breakout strategy, breakout reversal, and opening range. So breakout strategy, I was talking about the stock is making breaking out. Like for instance, Juno was breaking out and is still in the mode to break, go higher. I'll show you the chart. And the breakout reversal, you know, the Broadcom AVGO. So it was on my radar. On earning, it fell down. Then I kept on watching, and about 3–4 days ago, I saw it moves from the support, so I got in. So that's a breakout reversal. Opening range, I apply this technique every day. So I narrow it down. I focus it on the stock which are moving ahead. So it's like someone, my mentor, my boss, when I was working in full time. My boss told me that, Noshi, when you start something early in your career, then think of it as a marathon. So when you, if you are standing on the side of the road and that marathon run starts, everybody looks like running at the same speed. But if after a few hours or after a day, then you see there are few people, runners, they are moving ahead. So, or if you're on a helicopter, you can clearly see who is moving, ahead. So it's the same technique on opening range breakout strategy. You can, if you filter it based on the time, then you can see which stocks are moving ahead and which stocks have pulled back or going on the sideways. So those are the stocks which I monitor whole day, which are moving forward, and then I try to time my entry and get in. So that's the opening range breakout strategy. So you can apply this technique both on the upside or on the downside. Then another strategy, these 3-4 strategies, gap up, gap down, gap up reversal, and gap down reversal. So these 4. So when the stock gaps up, if the stock gaps up on beyond the resistance level, and then it's holding, so the resistance, if it gaps up above the resistance level and then it pulls back, that resistance has become now support. So if it pulls back to that resistance level, which was the resistance, now it's support on the gap up day, then you time your entry and you get in. That's the gap up strategy. The gap down is the stock gaps down below the support. So usually if the stock gaps down at the 200-day moving, gap down below 200-day moving average, or another support level, if you know. So if it gaps down below 200, and then after a certain time pass, it will start reversing to the upside, and it will try to conquer the 200-day moving average, because below 200-day moving average is considered bearish. So it tried to conquer the 200-day moving average, and sometimes the stock fails to conquer. So if it fails, you short the stock right there or buy puts, and your stop is above the 200-day average crossover. So that's another gap down strategy. Gap up reversal is when the stock gaps up, but it gaps up to certain resistance level. So certain stock gaps up and then there is no follow through, right? A lot of stock gaps up and there's no follow through. Only few stocks after gapping up continue to move up. So you can short the stock after gapping when the stock gaps up, but you have to really master this, and I have explained in my article. So that's kind of dangerous strategy. When stock gaps up, I've seen people gap, when the stock gaps up, they try to short the stock, and then they don't realize, they don't see the volume, the momentum. There's a huge momentum behind it, and then they lose. So gap up reversal is not a dangerous strategy. The gap down reversal, so I'll show you a chart of CTRP gap down and then it reversed. So I think it's going up. So some stocks, they gap down, especially when they gap down to 200-day moving average. So if you can set up this as a strategy, set up whatever way on your platform, any stock gapping down to right at 200-day simple moving average, you watch it for the first an hour or so, or sometime right get going, because the stocks after gapping down, they move up, especially on 200-day moving average. And if you are watching that stock during pre-market hours, if you can isolate the low of the pre-market and the high of the pre-market, note that price, and then during opening hours, see what the stock is doing. So this is the low. If that low is not being violated during an opening hours, chances are that the stock will not go below that low. So you have the risk defined right there. So, but you need to be aware of the low and high during the pre-market hours. And when the stocks makes a move above the high of the pre-market or after hours, one day before, you have a pretty defined area that what the stock can do, and then you have to just follow your instincts and go for it. So I do that all the time. So these are the another 4 strategies. So just a second. Okay, so I have a swing option service. The published price is 337 on my website. If you email me, it's only 267 today for the whole quarter. So I can send you the link. Now, this is a chart of Foot Locker. So Foot Locker has been, I prepared this and I'm interested in long. And the reason is that, look at this. I watched the Foot Locker on this day. So see, Foot Locker gap down. I think it was earning. And then if you draw this trend line, that after 2 days, it moved up huge. So this is the move which told me that I need to go long on Foot Locker. Foot Locker has established a base here, right here at 31. So it's very hard for Foot Locker now to go down. Chances are it is going up, and it will go up to fill this gap. There's a big gap here. And the first target is, if you are long shares, then this is your target, 45. So this is what they do. See, whoever wanted to sell, they sold out right here, and then the next day, few more sellers left. They sold. So there's nobody left to sell. So some news is coming, or there is a news or buyout or whatever. The stock is in up move. So this was the day I noticed, but I doubted myself and I didn't get in. So since then I've been watching. I said, okay, I need to get into Foot Locker. So for a few days, see, if we had gotten in this, we could have gotten out right here somewhere, but when the move stopped. But since I didn't get in, so I kept watching it, and I say, okay, I need to get in the Foot Locker. So on Friday it was making this move. So this is a bullish move for me, and I believe it's gonna go up. So if you are going long on Foot Locker, you have to define your risk, either 32.50 or 31. So you may want to get out half if you're wrong. 32.50, suppose it falls, but this is the bottom line, so 31 level. So I believe Foot Locker is going up, and it will fill this gap. So this is one potential stock for you. Another one, I'll show you some previous. Okay, so here is Win chart. So Win came on my radar on Thursday over here. So it came near the end of the day. I was watching Win, and I said, okay, I need to get in. But then I said, okay, I wait just one more day for Win to make a move. And the reason I didn't get in, because I had other positions open. So when you have many other positions open, then you just don't take any more. But I kept it on radar. But then on Friday, it gapped up. So Win is bullish. Win gapped up, and it's going. You see, it crossed all the resistance. There's no resistance. It's all white space on your left side. So do you see any candle here? There's no candle. So there's no resistance. It broke. Boom. So what is the probability of Win going up, then going down? So this is what I look at. So I say, what is the probability? The probability is high that it's going to go up, not coming down. It broke this resistance level. So any pullback towards 140 or little bit on Monday, and then add towards 140 is good. And if Win is going here, so if you extend this line, it will come to 149, 150 area. So you can always determine your target by drawing and extending the line. So if the stock is going on this side, suppose, then the line is extending. So your target is getting higher and higher. So if the stock is taking time, suppose it's making a like sideways move, making a base, but if the stock immediately moves, then this is your target. So around 149, 150 is my target for win. Burlington. So Burlington, this was the move on earning. So Burlington moved up on earning, and then it sold off. It came back down. So since then, I've been watching Burlington. I said, okay, what Burlington is doing, so I need to watch. So I make a short list of the stocks which have moved in the like recently, and which can move the next few days. So I keep it for 1 week, 10 days in the radar. So I keep building my watch list, and I clean it up every weekend. I go through and I say, okay, this needs to be discarded. This needs to stay in the watch list. So Burlington was in my watch list, and this is where I spotted that it's okay. It moved down, and then it started to move back in and cross the 50-day moving average. You see here. So so this is the probability that this is stacked to in the towards the long, so that Burlington is supposed to move up. So this was a long entry, and I got into Burlington, and then on Friday it gapped up. So Burlington is long, and if it breaks this 90 level, this is my initial target. If it breaks, so this breaks, and then this 92.50 level. If it breaks 92.50 level, it's going higher, because this is the level where it sold off on earning. So any leftover, suppose the sellers and this candle, any sellers are sitting here, and they may have bought it on a gap up um, on earning day. So they will say, okay, I'm lucky I got out at break even. So they are looking for exit at 92.50, whereas you're looking for acceleration to the upside, maybe 100, 102 level. So this is another setup I have. Now this is the CTRP I was talking to you about, mentioning. So this is stock gaps down, but then from the early morning I saw gap down, and then it reversed. So if this is when the stock gaps down and then it reverses, the longer you wait, the higher is your loss in future, and the less your profit. So I don't know why the professionals, they looks at something, right? So they know that they need to buy it. So they came and they bought it. So your if you want to follow them, this is your loss, stop loss, the low of the day. So you have to remember the low of the day around 48.50. So as long as CTRP stays below 48.50, I mean above 48.50, you don't have to worry if you're long, and just even a little bit lower than 48.50, because if you are setting up your stop at 48.50, then the big boys also know that you are doing it, and then they will come and like 10 cents below that, and then they will come back in, and then you're stopped out and the stock reverses. So you have to give some room to below 48, this below the low of this, and see if it holds. If it reverses, chances are the CTRP is not going to reverse below this. It may take time to move, but those who are buying shares and they have deep pockets, they don't worry about, I think, in my opinion, they don't worry about the time, or time is running out on me, the options, time decay, etc. They bought shares. So they bought shares, they know that, okay, the stock is below 48.50, and they are waiting for their payday. So the payday will come. When some news will come, this gap will fill, it goes up, and CTRP is moving, crossing 55, and we will talk about 50-day moving average crossover, whereas they got in right here at 50 level. So I bought some shares on CTRP, and I told my friend John, he is here, so bought it around 50.39. So CTRP is another one you can look at. Now DLTR, DLTR. So Dollar Tree, I had call and it gapped up, then it reversed. So this is the way it if we extend this line here, the 82 was the resistance, and then it's sold off towards this 200-day moving average. And now I think it's these candles, they are telling me that it can break below. If any news comes, it could break easily and come down to fill the gap towards 74, 75. So if you watch DLTR, then you know that above this 82 is a bullish, and if it starts selling off and breaks this 200, and it can come down towards 74, 75. So DLTR is in the middle. So this is another setup. MGen, yeah. So the biotech stocks have been moving for last 1 week. So MGen was on radar, and I had some positions in it. And then when I saw this move crossing a 50-day moving average, so what is the probability that when the stock is forming this pattern, holding this support and crossing this 50-day moving average, what is the chances of it going down or going up? So the chances are it's going up. So I bought calls at this level, added to my calls, and then next day I show you this is what MGen did. So the entry was here, and then it gapped, moved up this furiously, and then hit this resistance right here at 179. So I sold half of my position, and I'm holding another half. So if it breaks, then it's going higher, and biotech stocks are moving higher. So if it breaks this 180, 180.50, MGen could be going higher. So I just wait for it to make its move. So this is another setup I had, and I booked like I think $200 per contract. So something like that. The BABA. So we trade BABA quite frequently. So it's one of those stocks like Apple, BABA, Baidu, Facebook. So these are the stocks which, and Nvidia, these are stocks which every trader, swing trader, should have separate in the basket. So these are the stocks separate in my basket. They get a special treatment. So BABA, I was watching on this day. I think either this day or this day it was selling off, and all other stocks were moving up. So I bought puts, and I sent alert on puts, and we had good profit for next 3 days. From here onward, it came down. Then on 165, BABA found support. So I did not get in on this day. So I said, okay, I wait for another 1 day confirmation. So when I saw this move, second day move up, that's where I bought the calls. And I still hold the calls, and I have a vertical call spread position, and I'm expecting it will break on this. If when the move come, it will break this 175 level. So I didn't get in at, but I did tell one of my friend that look at BABA. He got in, but I did not. So, but when the next day I saw the move, then it was confirmed that okay, BABA will go up. So 3 down day, then the 4th day it stabilizes. So if that's aggressive entry. If you don't want, then the next day when it goes up further and little gap, that's when you get in. We were in profit. I didn't take the profit, so I'm still holding it. So I want one or two more days. I will get out with my long calls, but the spread I will hold for 175 break. So BABA is, this is the way I traded. So I made money on the puts, then I bought the calls. This Momo stock, so I watch Momo also. So Momo also moves, always doing something. So Momo broke down heavily. I think it was earning, and then it found this support. So again, if you look at this 200-day moving average and you draw the line, it's here. But I didn't get in at this level, so I wanted to, because it's very it's dangerous. It can be fake move to the upside. So you need another day confirmation. So when I saw this, I got in. I bought some shares, and we have a end of day service where I send it's like $39 a month. I prepare Excel worksheet and I put the stocks which are on my radar. So Momo was on that listed, and I do send out intraday alert also that this stock will be added. So if you're part of intraday, I mean end of day service, which is 39 per month, you get the alert. So very next day, Momo moved up, and the traders who were part of end of day, they made money on Momo. So this is what the Momo did. You see, the next day it gapped up. In fact, it was moving up during after hours. After we send the alert, it was moving up after hours. The next day in the morning, it was moving up. Then it gapped up, and so I exited. So I don't have Momo position. So I got out. This is the Broadcom. So AVGO is also one of my favorite. So when I saw this support, this stock is holding the support, I waited for the market, near market. So I said, okay, let me see if it holds this level by the time market closes. So 15-20 minutes left to market, I send the alert. I said, okay, buy AVGO, because what is the probability that of AVGO coming down then go up? So chances are that it will go up. So I send the alert to buy calls. I think October 250, and the target 250 and above. So another target was, I think, 255. So somewhere here, this based on this. So AVGO moved up. You see. So again, I base this. This is the support. This tiny candle after 3 down day on earnings. The fresh buyers are in. So made a big move. So I sold half at like 200 or something, some profit, and then I sold another half later at the end of the day. So on Friday I got out of AVGO. So I had shares and I had options. So I had both. This UTX. So UTX is, you see, what is the chances of UTX going down below this 200-day moving average when this is making this big move, right? So when you see the move like this, from 200-day, chances are that it will go up. You don't need anyone to tell you, okay, wait for this confirmation or wait for that confirmation. Your stop is below this 200-day moving average. So you get in. So I send the alert for UTX in my Leap service. So and it's right now it's just resting after this big move. The chances are that it will break this 50-day moving average and go up. So if you want to put this stock on your radar, you can. Apple. So we trade Apple and hardly lose. I don't recall losing on Apple. Most of the time, like very high probability Apple, make money. So Apple, again, Apple was constantly being bought right here. So I got in with the pause and alert around 162. I think I got in at 161 and change. And then I prepared the chart at 10:56 a.m. So so Apple, I don't have any position in Apple. I got out, I sold my calls, made money, but when it was breaking this resistance line, I got in on Apple. So Apple is still, I think I got out at 164 right here. Okay, so this is Juno. So Juno gapped up. So this is what I was talking about. So this gap up. So I drew this line. I said, okay, Juno gapped up. Now what's next? So either it pulls back, come down to 30, below 34, and it keeps going down, but it didn't happen. But look at this volume. So it was huge. So I said, okay, I need to get into the Juno. So believe it or not, I bought on this move. I think I sent the alert just for shares buying. I bought 4,000 shares, around 40 something, and sold at 43.60, 43.70. I made in one day, I made 17,000 on this move, only on shares. 4,000 shares I bought. 17,000. I'd send alert. Sometimes I send alert to those who buy shares, and I did send alert to all the members. Juno is moving. Now, after this move, so I knew that this is a big move, and I need to get out. So I got out, but then again, look at this chart. Juno is consolidating, and I think Juno will go up. So the buyers will come in. So the profit takers, they sold. So just like me, I sold it. It was one day move. I bought early morning and I got out. I bought here around here 40. I got out right here 43 something. It moved, I think 50-60 cents beyond my exit price. But now Juno is consolidating, and I believe it will go up. So any news, anything, something happens, then new buyers, and it's gonna go up. So Juno is the one you need to keep on radar. I have some calls on Juno. This is Nvidia. So Nvidia is the one I trade. Recently we made money. So if you draw the line, you have to be careful with Nvidia because of all the news. The short sellers, they come in. The short sellers only come in like Citron. They come on TV. They say, oh, we shorted this, and then they never come and say we covered or what happened to their shorts. They always come and advertise that they shorted it and don't know their exit. So Nvidia is in the up move and it's going up. So I had a long position and I exited. Sometimes I buy shares in my stock account and I exit same day, or I hold for one day and I exit. So usually in my stock portfolio, I divide my portfolio into 7 chunks. So 15% of my equity I put in, and then I try to rotate it. So if something else is moving, I get out and get into something else. I do take loss, but portfolio going up. This Dollar General. So Dollar General, we had a call position, and then when it gapped up, here we exited right there. We have been holding it for a long time, and then when we saw this move up, we exited because of this resistance, and now it's not doing anything. I mean, I think it's trying to, but it's choppy. So Dollar General is choppy. You see this? So you have to look on the left side and see what it's doing. So it's kind of choppy. Signet Jeweler. So this is another one I have a long position. Look at this move, the volume, how big it is, right? So this is a big move, and I got in the calls. So I believe Signet is moving up, and it could go easily to 70, 75 level. So keep an eye on this. Yeah, so see it's consolidating. So okay, so this chart was on 24th of August. So I bought it on no, this is ANF. Yeah, so okay, so I'm mixing up. Just a second. On 25th of August, I bought calls, and since then it has been on 10:30 a.m. I prepared the chart. Since then it's on the sideway move, but on Friday, do you see after this tiny candle, this Friday is poking, on Friday it was poking this candle to break. So if it breaks this 64.40, like this candle, it will go up towards 69. So this is where I will exit with my calls. Volume is drying up, but you know, it's still expected that it will go up. ANF. So I spotted this move on ANF and I bought calls and made money and sent the alert to members. So this big move, right, above 50-day moving average. So I said, what is the chances of ANF to go up then to go down? The chances was, you know, the volume was good, gapped up, 50-day moving average. I think it was earning. So I said, okay, this is where I will exit. So I exited right here. Next 2-3 days, it kept going. So this was the move I exited. So on a swing trading, you don't, if the move is happening right next day or within few hours and you are in option, it's better to take profit, at least majority of your calls instead of holding it, because there's something coming up. You just have to look. So this was the move. I exited around 12. My target was 12. 12.15 was the resistance I mentioned, and when it held 12.15, I exited at 12.15 because I saw at 12.15 is holding it. So, but it moved. See, ANF now at 13. So if you look at this move, big volume above 50-day moving average, gap up. I had too many shares on ANF. I mean, I mentioned privately to somebody. Uh, I had 15,000 shares. I bought 15,000 shares on ANF on this day, and I made 1 point. My target was 1 point. So I got in at 12.15, but it's still going up. So if I held it, this is, fortune, but I did not. I got it at 1 point gain. But overall, when the portfolio going up, it's okay. So I do have a 6-month mastering the markets coaching program. So it's a 6-month long, and if you're interested, you can send me email, and we will talk about 40-minute. We can have a strategy session, and we talk about it for 40 minutes. What it is, how it is, and what you will get. Everything is detailed during our 40-minute strategy session. So just send me email at this email address. Again, the swing option service is 267 today instead of 337. If you're interested, please send me email at noshi@financialmarketwizard.com. I'll send you email. Okay. The next webinar will be on September 10th, 5 p.m. Now, position sizing. Already 45 minutes gone when I covered one topic. Okay, so let's discuss position sizing. So another 30 minutes. So if you want to hang on for another 30 minutes, another topic. 2 people left. They thought this webinar is over because I was talking about my offer, and they left right away. Two people. So it's their loss. Well, this is a more important topic, position sizing. So that's why traders don't make money. They just concentrate on the hot stocks. What is moving. AMD is moving, or DRYS is moving, or it was at $3.50, now it's $2.50, 1 point loss. Oh, Bitcoin is moving, okay, should I buy? Then they do all that. There is no system. There is no systematic approach to trading. There is no proper setup. There's no proper exit. There's no management. They don't have a pre-filtered selected stocks. They are not stocking the stock. They're just jumping. So that's why they lose. So 90% traders, they just come and go, and then only few traders make money, and they don't put time. So just like those two, they jumped. So let me explain position sizing. So let me open another presentation. Okay, so another one. Okay, so position sizing. I have not covered this topic for a long time. Let me see what I wrote. Okay, so this is another famous quote. He who thinks he knows doesn't know. He who knows what he doesn't know knows. So we need to know about our shortcomings. It's very important. So I try to improve my shortcomings. During trading hours, I'm not doing anything. My room is locked. So I come in my office at 5:30, and first 2 hours it's like dead silence. Only TV is running on a mute, like little low volume. I have read the news. I know what the stocks to watch, and I'm focused. When the market opens at 6:30, I'm like, boy, don't talk to me, I will bite you. So, I don't need coffee. My coffee is over. I don't need breakfast. I don't turn on my phone. My phone is off. I'm concentrating on market, and usually it goes for 2 hours. Then I'm, kind of little come down. Then the last hour, I'm also watching what's going on in the market. So I try to improve every day. I say, okay, I'm tweaking, I'm contacting my programmer. I'm telling him do this, do that, and I'm saying, okay, this one is working, this is not working. Why did this setup didn't work? What I need to do, so what changes I need to do. So whole day, like till market hours, I'm doing nothing, just doing that and taking care of my members. That's my objective. There's nothing else I do. And I believe in position sizing. Whenever I don't follow, I lose big. So my loss comes when I don't follow this rule. So why position sizing is important? There are 9 reasons. When you have a proper position sizing in your trade, then you eliminate the fear factor. So this is the factor of fear and panic, which causes us to lose because we jump out the ship. We can't bear it, you know. I start biting my pinky. So when you start biting your pinky or you're grouchy, then you know that, okay, this is it. This is the reason. You know, you put all your money in 1 or 2 trades and eliminate a rate of error. So if you follow the position sizing, then you are, even if you're wrong, you're staying in your live to fight, and you build your confidence, you build your discipline, because you know you did your best. Now the trade needs to work. If it doesn't work, okay, you lose. So you have faith in the trade. So if you have faith in the trade, and that's what whenever I put a trade, I have solid 100% faith in the trade. I'm not like, will it work or will it not work? It's not like that. So you need to have a faith in the trade and stand firm by your conviction, right? So you need to stand firm by your conviction. You can survive bad trades, and it eliminates bankruptcy in trading. So these are the reasons for position sizing. So if you don't want to go bankrupt, you have to follow the position sizing. Okay, next. So what is position sizing? So position sizing tells us how many shares or options contract per trade. So like for instance, in my stock portfolio, I try not to buy too many shares in one position, and if I do, then I have to reduce my position right away before I see the loss. So but it's better that I stay within the dollar amount I have allocated for that trade. So usually I put 15% of my portfolio in one trade. I'm talking about shares. So 15% of my portfolio. So I know that, okay, 15% is what dollar amount, and then I buy whatever shares I buy. I round it to, you know, round levels. So this is what position sizing is. It tells you how many shares or options contract per trade you trade. So controlling your per trade size as function of risk. So you define your risk of your portfolio, and then you control that risk through by per trade. So I'll explain what I'm saying. So there are 3 variables to position sizing. Your portfolio size, which you know. So let's say your portfolio size is 50,000, 100,000, 10,000, 5,000. So that's your portfolio. You define your risk tolerance. So risk tolerance is that you don't want to lose more than, suppose, 2% of your portfolio in any given trade. So if your portfolio is 100,000, you don't want to lose more than 2,000 in any trade. So that's your risk tolerance. So you define that in the beginning. And then your stop loss percentage. This is the thing, stop loss percentage. This is what you can vary, and it varies from trade to trade, because different trade has a different setup and a different risk. Some trade have a lower risk, some trade have a higher risk. So this is what it tells you. First, you need to find out your stop loss, and then it will tell you how much you need to invest in the trade. And these two are constant. Your portfolio is moving up or down every day, right? So I track my portfolio balance. I know my portfolio balance. In fact, I have a virtual assistant who helps me. So at the end of the day, he asks me, what's your portfolio balance? So I give him my portfolio balance. So he maintains it, and then he tells me how I did. I know how I did, but he tells me, he give me other data also. So he runs some calculation, and then he tells me this is what it is. So he knows what I'm doing, right? And he's my accountability partner. So I mean, if my portfolio goes down, he knows. If my portfolio goes up, you know, and he's a virtual he's a virtual assistant, and he's overseas, and you know, dollar wise, dollar per hour is his salary is low, and then when he see me, you know, making this big gain, oh boy, so sometimes I don't feel good. You know, for him it's a big gain, dollar percentage, like he can buy a house over there on 1 day of profit. So anyway, so you need to have an accountability partner. So you make your trading partner or your friend or somebody, don't make your wife or your husband as your accountability partner. That's not going to work. Other than that, make someone your accountability partner, and then tell them your portfolio size every day and track it in the worksheet. So based on the portfolio size, you know how much you will risk, right? So dollar amount. And then on the trade basis, you know what's the percentage loss, like 50% on option, or 65 or 100% and 25%. Then you know how much you will invest. So I'll give you the formula. So the formula is, first we define the risk tolerance. So how much you are willing to lose as part of your total portfolio amount. So risk tolerance is, suppose you have a portfolio of 100,000. So how much you're willing to lose? You're willing to lose 2%. So that's $2,000. If a 50,000 portfolio, then $1,000 you're willing to lose in that portfolio. The stop loss. The stop loss is how much you're willing to lose in that given trade. So some trade you can lose 25%. For option trading, right off the bat, you lose like 10-15% because of the spread. And then if the trade goes right away in your and doesn't go in your favor, you lose another 5-10%. So 25% loss is normal in option right away. So your stop loss needs to be above 50%, 60%. So you can even lose 100% in an option trade because it doesn't work. So you need to know that. Then when you put all these three things, you know how much you need to put in a trade. So position sizing models. There are two position sizing. There are other position sizing models, but the famous ones are percent risk model and percent volatility model. So we will discuss the percent risk model, not the volatility model. So percent risk model. The formula is the portfolio size. So let's say you have a portfolio of $50,000. Then you divide by a loss percentage. So on that trade, so you know, okay, this trade I'm putting on the option, I may lose 50%. So you divide by 50% of your portfolio size, and then you multiply the risk tolerance percentage, so which is 2%. So keep, you can create a little worksheet, and you say, okay, my risk tolerance is always 2%. So that's constant. Your portfolio size doesn't vary as much on a day-to-day basis. On a weekly basis, you can adjust it, see your portfolio size, what is at the end of the week. You update that portfolio size at the end of the week in the worksheet. All you need to do is set up your stop loss based on the trade. So this is what you have to define. So it will tell you how much dollar you will invest in that trade. So this is the little formula. So let me explain to you how to calculate the risk amount. So let's say portfolio size is 50,000, right? So this is constant. It's not changing. If your portfolio is not, just assume it's not changing on a day-to-day basis. Just think of it as a weekly update. So on a weekly basis, you update it. So it can be 52,000 at the end of the week. It could be 48,000. So just update at the end of the week, unless it's dramatically changing, you know, on a day-to-day basis. And then risk tolerance is constant, 2%. So your risk amount is portfolio size into risk tolerance. So your risk amount is $1,000. This is what you are willing to lose on one trade. So $1,000 based on your 50,000 portfolio and 2% is stop loss, risk tolerance, sorry. So if you're willing to lose $1,000, then what should be, how much you need to invest in the trade based on the stop loss, based on the setup. So, but you have identified this dollar amount that you will not go below $1,000 stop loss. So let's take an example of Amazon. So Amazon is your outlook is bullish on Amazon, right? And your stop loss percentage based on your chart and technical analysis, you say, okay, I could lose 50% on Amazon, and it's easy to lose on 50% on Amazon. So let's say current price of the call is $20. So if you buy one contract is $2,000. So $2,000 buy you one contract, and your stop loss is 50%. So if your stop loss hits, you will lose $1,000. That is in accordance with your that is in accordance with your risk amount. So you're willing to lose $1,000 based on your portfolio size of 50,000 and risk tolerance of 2%. And Amazon contract, it's a coincidence because I made this example to fit in, to give you like example in a easy way. So $2,000 is a Amazon contract value, and if you lose 50%, you will lose $1,000, which is in accordance to your guidelines. So that's what you have. So this is this. So how many contracts of Amazon you will buy? You will buy only one contract. You shouldn't be buying two contracts. The moment you buy two contracts, then you have to do. You are doing two things. Either you have to lower your stop loss percentage, which is 25%, or you are increasing this risk tolerance of from 2% to 4% if you're keeping the stop loss percentage at 50. So too many traders, they buy too many contracts on a stock like Amazon or PCLN or Google, and then they lose big because they are not even supposed to buy one contract based on the portfolio size, but they do buy, and then when they lose big. So when they lose big, what happens? If you lose big, then your next trade, you let it go. You don't get in because you have lost money. So you miss so many opportunities. Then you have to have so many gains, small gains to recover this $2,000. So it's not a good idea. So don't do this. So I give you example. So risk tolerance we define as 2%, right? Based on $50,000 portfolio, our risk amount is $1,000, and the contract buy price is $2,000. Our stop is also defined as 50%. Our stop price is $1,000. So how many contracts? Based on the formula, we can buy only one contract. And the way we calculate it is like this. The portfolio size, which is 50,000, divide by a stop loss, which is 0.5, multiply by the risk tolerance, which is 2%, give you the investment amount of $2,000. So this is what you need to calculate per trade, investment amount. And then you say, okay, how many contracts I can buy? You can buy one contract, right? Also, you have to think about the averaging down. So if you're averaging down on a position which suppose it was losing, and then the stock is on its way up again on the direction you have defined, you may have to buy more. So if you invested all your money in the first time, then you don't have any money left to invest the second time because of the cost averaging down. So you have to take into that consideration. But anyway, if you don't want to, suppose you are not planning to average down, then only you can buy is one contract based on your portfolio size of $50,000 and risk tolerance of 2%. Okay, now you can increase your risk tolerance. You say, no, 2% risk is too much. I am willing to lose 4%. So if you're willing to lose 4%, then your risk amount is $2,000. So your stop loss will remain the same. Suppose, let's assume the stop loss is 50%. So how many contracts you can buy on Amazon when you raise your risk tolerance to 4%? You can buy 2 contracts, because the formula says $50,000, the stop loss is still 0.5, divided by risk tolerance, which is 4%, give you the investment amount of $4,000. So $4,000 means 2 contracts, because each contract is $2,000. So in other words, if you invest $4,000 and if you lose based on your stop loss of 50%, you will lose $2,000, and this $2,000 is 4% of your portfolio, which is $50,000. So you can increase the risk tolerance to increase the bet size, or you can increase the stop loss percentage, decrease the stop loss percentage. I'll explain, I think, in the next example. Yeah, decreasing the stop loss percentage. So another example is, you keep your risk tolerance at 2%, right? So you say, no, I'm only willing to lose 2% on my portfolio. So you are only willing to risk 1%. But you say that, okay, this stock, my entry is perfect, or I know that if I lose only 25%. If I lose more than that, I will get out. So when you promise yourself that I will get out at 25% loss, then you can increase your bet size on this trade, which is $4,000, because your portfolio size is 50,000, your stop loss has gone down to 25%, and your risk tolerance remains same, 2%. So you can increase your bet size to $4,000, but you have to, and then 4,000 will bring you to 2 contracts, but you have to follow your guideline that you will say, okay, if I lose, I will lose only 25%. So when, like for instance, when the stock gaps down at 200-day moving average, and it just a little below, and then it's moving up fast, so you say, okay, I know this is gonna go up, and if I'm wrong, I'm wrong, I will lose 25%. So at that time, maybe you can, your bet size will go up, because you know that, okay, I will get out at this price, the low of the day. So for suppose CTRP, the low of the day, suppose 48.50, and you are getting in right at 49 when it's trading at 49. So stock wise is only 50 cents, right? So you can buy a bunch of contracts. You bought a bunch of contracts, and then as long as if it comes down below 48.50, you will immediately get out. So your stock, you will lose 25%. But if it goes up, then you will lose you will gain a lot of money. So in this case, you have to be very precise in your entry, or high conviction. But high conviction doesn't work. It doesn't matter how much conviction we have, there is always something which will come. So again, I explained to you some scenarios. The risk tolerance remains the same at 2%. The percentage of stop loss is 50%. Your portfolio increase, so your per trade amount will increase, right? So if everything is constant, like risk tolerance is 2%, your stop loss is 50%, but your portfolio increase because you made money, then your bet size will go up. But if your portfolio size decrease, then your bet size will decrease also, based on everything else constant. So normally traders, what they do when their portfolio is decreasing, or because they're losing, they are increasing their bet. So they follow the casino strategy. It's called, I think, martingale strategy. They increase the bet because they think, okay, next time I will win more. Because I have lost 3 times in a row, the 4th time it will be a winner. But the 4th time also becomes a loser. So you have to decrease your bet size. When you are winning, you can gradually increase your bet size. When you're losing, you have to decrease your bet size. Some traders, they follow this strategy. They win, they Like for instance, if they buy 2 contracts, if they win, then the next trade they buy 3 contracts. If they lose, they decrease from 3 back to 2. If they lose again, then they come down to 1. But when they win again, suppose they bought 1 contract, they win, they go to 2, and then they follow their portfolio size. So it depends what you are doing. The another scenario, you can increase your risk tolerance to 4% because you say no, 2% is too low. I'm willing to lose more per trade. But your stop loss is same. So your per trade amount will increase. Like Amazon example, you can have 2 contracts if you increase your risk tolerance to 4%. So this is another example. Scenario 3, suppose your risk tolerance remain the same, but your stop loss increase to 100%. There are certain scenarios where you can lose all in options. For instance, the option when it's trading $1 or below. So on a $1 or below option, when the stock moves a little bit on your against you, you can lose the whole, whole trade. So your stop loss is 100%. So if it's 80 cents a contract, the stock goes and the bid is at 70. So you bought at 80, the bid is at 70. The stock didn't do anything. So suppose your option closed at 65. Next day the stock goes down a little bit. The option is trading at 20 cents. So you can take loss at 20 cents, which is 75%. Or suppose you didn't. The next day it's like 5 cents. Now you don't want to close because it's at 5 cents. And it can go up back to 80 and $1.50. It happens. But suppose it doesn't go down or go up, 5 cents becomes 0 cents. So when it becomes 0 cents, it means 100% loss. So when you see that you can lose 100%, then you have to adjust the trade. So your per trade amount decreases because that's your total loss. So if I see that I will lose my $2,000 in Amazon, maybe that's not the trade for me. But if I lose, then my risk tolerance will go up from 2% to 4% because I define $1,000 as a profit, as a loss, but now I'm losing all $2,000. So we have to be aware of. Another scenario I explained that you can decrease your stop loss, and the stop loss percentage is only when your entry is so perfect in option trading that you say, okay, I will lose only 25%. If I lose, I know I'm wrong. I can get in, so you can increase your trade amount. So 7 lessons we learned via position sizing: that we need to start small, avoid risky trades based on your portfolio size. So not all trade fits your portfolio, like Amazon, Google, PCLN, sometimes the other one, they don't fit. So you need to ignore that trade. You can manage your losing streak. So if you are following position sizing, you can manage your losing streak, and it still will live to fight for another day. And you will avoid the gambler's fallacy, where traders bet more when they're losing because they think the next trade will be the winner. And another thing is avoid time-based profit objective. So this is what traders do, and they lose. This another thing is they have objective for making money every day or week. So if they have objective of making $1,000 because of some bill pressure that they have to pay the bills, suppose they want to make $1,000 a week, and they are down, suppose $1,000. So they want to make money, or they made suppose $800. They are short $200. In order to make gains or make $200 profit, they say, okay, I need to increase my bet size. Then when the stock moves a little bit or option moves, I will be able to lock that gain. So they increase the bet size. Instead of their portfolio saying 5 contracts, they buy 20 contracts, because they say, okay, 20 contracts I buy, if the option move just 10 cents, I will make like $400. That will cover my objective. But even that 10 cents profit doesn't come, not even 5 cents. The moment, like as if the stock found out your objective, and it goes the other way. And so that is time-based objective. So avoid this. I don't have a time-based objective, so I don't do that. It puts pressure. I try to stick onto my position sizing plan, and I've noticed whenever I go out of the way and I lose, boy, I lose big. So your objective is to grow your account steadily. So take modest profit, don't overtrade, follow the rules. So this is by Dr. Barton, and he's talking about the story of a blown up account, and he's saying, I have talked to many folks who have blown up their accounts. I don't think I have heard one person say that he took a small loss after a small loss until the account went down to zero. Without fail, the story of the blown up account involves inappropriately large position size or huge price moves, and sometimes a combination of the two. So they take on the large position, or it so happened that the news came out and the stock gaps down big and you had no control and you lost it. So try to, because we need to always aware that there is some unknown there which we don't know, and the thing can hit and we can lose. So the stock can gap down, gap up, anything can happen. The war breaks, some unknown, lot of variables which are not under our control. So it's not an easy job. Once again, I have a 6-month Mastering the Markets coaching program. If you're interested, let me know. Send me an email at noshi@financialmarketwizard.com and we will talk. Okay, so this slide is wrong. I offered one time $17 for the first month, and then $117. It's no longer. I do have an offer for $267 for 90 days. So $267 for 90 days instead of $337. So this offer is closed. And you will get the 82-page trading system guidebook when you sign up. And you will get the lessons for 1 month out of this trading system guidebook. So I've explained what I do and what you need to do, and just trade like a robot. So you get this guidebook for free if you sign up. Just send me an email. And this is it. Thank you for coming, and next week we will have another topic, probably on ETF. So thank you. Take care. Let me see if you have any question. Let me see. Any questions? I have to go to church, dinner. I have to get to work. Still hanging in. Bye. That's it. There's no question. Okay. So if you have any question, please send me email. Thank you. Bye.